Thank you very much for taking the time to attend this webinar today. We have a terrific turnout and a great topic and three awesome panelists. So just want to thank you for taking time on your busy schedule to attend this. What we're going to talk about today is using 1031 exchanges and the estate planning benefits of doing so. My name is Tom Rushav, and I'll be the moderator for this event today. And we want this to be a free-flowing event. The panelists are free to speak amongst themselves and address each other. And for all the people in attendance, please feel free to use the chat button to ask a question at any time. We want to keep this a very open forum and free-flowing. And I wanted to give a shout out to Alec Hamer. Thank you, Alec, for your hard work and great job of getting this all organized and set up. He's the webinar behind the scenes guy today. So our panelists, first off, we have the one and only, the Jeff Peterson from CPEC1031. He's sponsoring us today, otherwise known as the 1031 guy. We have Corey Edmunds, principal at Boeckermann, Grafstrom, otherwise known as BGM. And then we have Brian Weisberg with Siegel, Brill, and estate planning attorney, amongst other things. So thank you all for being here today. So we're going to get this started off here. I'm going to ask Jeff first, just for sake of conversation. This may be very elementary to some people on the call, but to some it may not be. What exactly is a 1031 exchange?
Well, a 1031 exchange is a provision in the tax code that allows you to defer your recognition of gain of taxes when you're selling investment or business property, typically through an accommodator, such as a qualified intermediary. And the sort of litmus test is the property that is being disposed of and received has to be real estate that's held for investment or business purposes or for use in your trade. Things that don't qualify are inventory, like flip properties, or personal use properties, like your home or your cabin or second home that's a recreational personal use kind of property. So those types of properties don't fit into the paradigm for 1031. Also, one really kind of interesting facet of this is that it is an exchange. So the same taxpayer that sold the relinquished property has to be the taxpayer that receives and completes the circuit by acquiring the replacement property. So it's an exchange of asset A for asset B. Now, in the realm of estate planning, many taxpayers don't really have their estate plan in place before they've sold their relinquished property and may be doing some of that organizational work. And they ask, well, can John Doe sell his relinquished property and have John Doe as trustee of his own grantor revocable trust receive the replacement property? Is that going from apples to apples? And it is. Generally, a revocable grantor trust is going to be running under the same Social Security number as John Doe in this hypothetical. And it's going to be considered a continuation of investment by John Doe. The same thing goes for a single member disregarded entity, such as a pass-through LLC that is wholly owned by John Doe. That would be another suitable way to acquire the replacement property. And then mechanically, you know, there are some barriers, obstacles to doing a 1031 exchange that are written into the regulations. One of those is that you have to identify the replacement property within 45 days after the date of the closing of your relinquished property. And you have to receive the replacement property within 180 days of the disposition of the relinquished property. So you've got these two time deadlines kind of running concurrently together after the date of closing of the relinquished property. And I'm just going to ask the panelists, is it a hot real estate market or is it a hot real estate market? It's a hot market. It's hard to find replacement properties. And that 45 days will be the fastest 45 days of your life. So when we talk about estate planning, we also need to be thinking like a chess player on moving, thinking ahead 2 moves ahead. And 2 moves ahead means you need to be able to identify your replacement property, designate it within 45, and receive it within 180. And if you're trying to also layer in some estate planning into that, that makes it even more challenging. We want to be able to complete the exchange, and we want to complete it in a way that's an organized and suitable way for your long-term planning.
That's great, Jeff. Thanks for that definition. As Corey and Brian would say, everybody has an estate plan. It just depends on whether it's your plan or it is the state's plan or the federal government's plan, right? So Jeff, you always have a saying, defer, 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 die, right? So how does that tie in, or what do you mean by that?
Well, first, I just want to say one of the great things about my job is that I get to collaborate with really smart and capable professionals, accountants, attorneys, professional planners, financial advisors. It is so rewarding and fun to work with other professionals. And everybody on this Zoom meeting is just at the top of their game. So it's super fun to collaborate with you. But right now, the mantra, because there's a step up in basis, when you receive property as an inheritance upon the death of the grantor, that you can receive the property, and instead of having the decedent's low basis during their lifetime, the basis gets stepped up to the fair market value at the time of their death, generally speaking. So rather than sell the property and unnecessarily trigger the recognition of gains in your latter years, the thought is, well, I'm going to take these gains to the grave with me. I'm going to die. I have to stop breathing for this plan to work. But when I die, then my kids can inherit the real estate with a stepped up basis. Now, what I've noticed is that a lot of people that have made money in real estate, their children are either super high performing professionals. They're doctors, they're bankers, they're really busy with their careers and have no interest in their parents' real estate holdings, or they just don't have any interest in real estate because they've watched their parents toil, labor, and suffer with the toilets and the tenants and the trash and all of the problems of real estate. They don't have any interest in repeating that story. So there are some challenges with estate planning and thinking about the next generation, because the kids may not have the aptitude or the desire to take on that responsibility.
Very good. Corey or Brian, do you want to comment on that?
Yeah, sure. Yeah, I find a lot of my clients, they'll do pretty much anything they can to avoid paying tax. And we want, like Jeff said, if you can take this property and roll it into something else, even if it's a vacation home down in Florida or Texas or Arizona that you rent out for a couple of years and continue the investment treatment of the property to maintain that consistent, essentially business use of the property, you can eliminate that gain and defer that to a later date, and hopefully forever if it ends up in your estate.
Very good, thank you. So let's go to, there's a few questions coming that we're going to get to in a minute, but I wanted to go to Brian. And Brian, could you please explain on what Jeff just talked about? What exactly is a stepped up basis at death? What do they mean by that?
Yes, under the current estate tax laws, when an individual dies, all of his or her assets are revalued to their fair market value. And that is the value that the estate tax is imposed upon. The trade-off that the current tax regime contemplates is that, except for a few categories of assets that are called income in respect of a decedent, like your retirement funds or other installment sales, all of your assets are given a new basis, which is the value that is used to determine the gain that you incur when a sale takes place. So if you owned an apartment building for a long period of time and depreciated that down to a very low value, but then owned that property at death, the value of that asset would be stepped up. And if you turned around the day after death and sold it, your capital gains and other gains on that transaction would be zero if you sold it for that new stepped up basis. The other advantage of the stepped up basis is that with real estate, you, under certain circumstances, you will be able to redepreciate that asset again after the step up. So you'll be able to take depreciation deductions a second time. And those are some very significant advantages. That goes to Jeff's comment earlier of the defer, and then die, receive the step up and avoid it. That's the ultimate tax avoidance use of the 1031 exchange.
Great, terrific. Corey, let's just say somebody did not have an estate plan. Can you give an idea? We don't need exact numbers, but give an idea of what kind of estate taxes somebody would pay on a property if they did not have an estate plan and did not get the stepped up basis, or sold maybe prior to their death?
Sure. So right now we have, I might be walking into some of Brian's territory, so he probably know the exact numbers here, but so essentially right now the federal limit is over 11 million for an exemption. So it's pretty easy for a lot of people to get under that number. But as a Minnesota resident, I think the numbers, it's north of 3 million right now. And I think Governor Walz was actually proposing to bring that number even lower. So you have the challenge at the Minnesota level, and that could be the same for other states as well. And some of these big commercial buildings can get to 3 million pretty quick. So you know, you're looking at a taxable estate in a hurry at that point. I should back up for a second. Am I answering that the way you're expecting, Tom?
Yes, yeah, for sure.
Okay.
Yep.
I would just follow on Corey's comments. He's correct. The federal government has a unified credit that can avoid estate and gift tax. So it's both used to shelter in lifetime gifts and gifts at death, whereas Minnesota, which is the state where we're all currently located, has just an estate tax that has that $3 million limitation that Corey referenced. So you might owe Minnesota estate tax and not owe any federal estate tax if your estate is properly planned. The other point is that those limits are per individual. So a husband and wife would have twice the numbers that we've just described. And a properly planned estate would allow a couple to defer the estate tax until the second spouse's death, because assets left to your spouse are not subject to those limitations. So the properly planned estate will not incur an estate tax until the second spouse has died. One of the advantages is that the stepped up basis occurs on the first spouse's death. So you can also diversify your portfolio after the first spouse has died without triggering or incurring an estate tax at that point in time. One other thing that I thought worthy of mention, because it's in the news quite frequently lately, is what are some of the contemplated changes to the estate tax that the current administration is considering. We are faced with, if the next round of spending is to take place, there are some proposals that would impact the topics that we've been discussing. And three of the most significant ones are lowering of the unified credit amount from the current $11.7 million per person. That number automatically cuts in half on January 1st of 2026. So that change is already baked in, but they're talking about accelerating or even lowering it further. The second topic that is being discussed is the actual elimination of the stepped up basis above a certain amount, which would be very impactful on individuals. And then the third that is being discussed is a third tier of capital gains rates above the current 20% for high dollar individuals. The situation with your real estate is that you may be below that threshold every year, except for the year that you dispose of this long held high gain asset. And so you could be subjected to this higher capital gains rate if any of those proposals take place. Those are just contemplated changes. They're not currently part of anybody's plan, and what people talk about while they're running for office is always different than what actually becomes law. But nonetheless, those are areas of interest for the legislation that is contemplated going forward.
Say, Brian, one follow-up question for you. You know, many of our clients amassed wealth in real estate over a long period of time, and now they're in their golden years, and they may have moved to California or Texas or Wisconsin, community property states. Does that change your analysis on the step up in basis if they've relocated to a community property state or outside of Minnesota?
Well, as a Minnesota lawyer, I'd have to bring in some expert counsel for those community property states. But the answer to your question is yes. How assets transfer in terms of your estate plan are impacted by the local law and also by the federal and state taxation scheme. So stepped up basis is something that is a local concern as well. So yes, if you do change your residence, you need to make sure that you consult with local counsel to confirm that your current estate plan is valid. One other add-on point is that some states like Minnesota have concern where a lot of its residents attempt to modify their residence for purposes of taxes, becoming snowbirds and permanently residing in Florida, but continuing to own Minnesota real estate in pass-through entities. And the current Minnesota estate tax treats any real estate owned that is sitused or located in Minnesota as a Minnesota taxable asset. So even though you are a Florida resident, if you own an apartment building or other type of real estate here in Minnesota, either in your individual name or in a pass-through entity, that asset would still be potentially subject to a Minnesota estate tax.
Brian and Corey, do you think that the small family farmer that has a lot of wealth tied up in their land would be adversely affected by the elimination of the step up in basis and the ability of family farms to continue after the death of the current owner?
Absolutely. I think, and I think that goes even for residential buildings and commercial buildings and any of those situations. If, you know, one thing to think about is if the decedent has all of their assets tied up in real estate and they're not very liquid and they have an estate tax obligation, the question is, how do you pay for that? Now, there are some rules, and Brian, I'm sure, would have lots of background on this, that certain businesses you can defer out some of those taxes for family businesses. But still, at some point, you have to face a situation where you have to come up with cash to pay the tax. And that could be very difficult. Even if you're under 11 million as a Minnesota resident, you still could get over 3 million and pay this state tax. Yeah. So that's a concern, definitely.
So many of our clients are real estate rich, but cash poor. They don't live extravagantly. They don't have a lot of cash. They don't have a lot of liquidity. If they were to die with a big estate tax problem, I suppose their heirs would have to sell the assets to pay the tax, sell the farm to pay the estate tax. And I don't know how the farm continues to operate in that situation. It would be a sad outcome, I think.
And I would agree. The hard part about the estate tax is it's challenging to plan for because it is death that triggers it, and we don't know when that event is going to occur. As Corey said, the need for liquidity at that point in time may drive a need to trigger the second tax if the step up is eliminated, which is liquidating an asset and triggering now a capital gain. I don't sell life insurance, but that is one of the main reasons why insurance agents are able to sell large policies to individuals that are facing those types of taxes, because the payment from the insurance company coincides with the death when these taxes might otherwise be due. And that sometimes forms an important part of an individual's estate plan. So
if I'm building my real estate empire and I'm young and in my 30s, Is that a good time to sit down with an estate planner and an insurance agent and try to procure that life insurance when you're young and healthy? Or should I wait until I'm 75 to sit down with the attorney and the insurance agent?
I always answer that question. You can never have too much insurance on the day you die, but insurance is not free. And so you need to be very mindful about how you allocate your resources in terms of affordability of premiums. One of the biggest concerns is ensuring your insurability, because if you become ill with a disease that makes you a much higher risk from an insurance standpoint, having had a policy in place that has a guaranteed death benefit is important. So that's a good question to ask your professional agent, but it's never too soon to investigate some of those opportunities.
Thanks for bringing those points up. It could be devastating to have to sell a piece of property to pay estate tax, especially if there's no stepped up basis. That's something that I didn't consider, and that could be really difficult on a family. And like Jeff said, it could destroy a family business or even a family farm, whatever it might be. So there's a couple questions we have. The first one here, I think, will be to you, Jeff. It goes back a little bit. It's coming from Scotty's asking, you can sell first as long as you ID a property to purchase within 45 days, right? So it says the replacement property doesn't have to be identified before closing on the investment property sale, which we think that's all correct, right? You sell first and then identify.
That's right. You definitely can fly by the seat of your pants and wait until day 44 in your identification period to, really hone in on what you want to identify. However, I think if you do your homework early, even before you've sold your relinquished property and started to think about and hone in on your replacement options, you will benefit from that homework because it is a very tight market. If you want to go back into traditional brick and mortar, it is a very competitive market. And wouldn't it be nice if you were going to identify brick and mortar, traditional real estate, that you have a purchase agreement already in place on your replacement asset, the target replacement property. That way, when you identify, you have the certainty that you're going to be able to acquire it. It can't be sold out from underneath you because you have it under contract. Many people get locked up with paralysis and they can't decide what to identify and they can't decide what to pull the trigger on. Meanwhile, all the other buyers in that marketplace are competing with them and gobbling up the available inventory. Places like Colorado, Florida, Boston, it's a very competitive marketplace and people are making offers sight unseen, full price offers, and getting outbid. So you really need to think ahead like a chess player if you want to be able to navigate these deadlines. But the questioner is right. You can wait until the 45th day to identify and designate officially your replacement property. My suggestion, my pro tip is think ahead, plan ahead, so that this is not as a stressful or difficult task to achieve.
Terrific advice. Good. Dave is asking, I'm sorry, Brian, go ahead.
I was just going to add on to Jeff's comment that having a purchase agreement in hand is obviously a very safe way to know that you're going to have a rollover opportunity. And a properly drafted real estate purchase agreement can have a series of contingencies in it where you have the opportunity to back away from that transaction should certain events arise, and you can be as specific as if your sale falls through for whatever reason. In a tight market, sellers obviously want to limit contingencies, but there are opportunities to avoid being obligated to buy something if your sales transaction doesn't actually occur.
Great, thank you, Brian. Corey, this is for you. This is coming from Kevin. Is there a limit to how much basis can be stepped up? Or can it be an infinite amount? It could be $1 billion. I mean, is there any limit?
I've never heard of a limit. No, it's unlimited. Whatever the fair market value is on the date of death, or there's an alternative 6-month date as well, but yeah, unlimited.
Wow. Very powerful. That's huge. So if you own assets, let's say the properties are owned inside of a trust, and I'm sure there could be difference if it's revocable or irrevocable. will the step up in value still take place inside of a trust if that property, investment property was owned inside of that trust?
Still with me, Tom?
Sure, yes.
Okay. Yeah, so if it's like a grantor type trust, like Jeff had mentioned earlier, where it really looks through the trust to the individual, where like the property is going to be reported on their personal return as if they own it themselves, then yes, it would be stepped up. If it's in a irrevocable trust, meaning that the grantor has relinquished ownership to that property and is now in this trust for the benefit of their heirs, then no, it wouldn't be stepped up. So
Okay.
basically like a grantor type trust, you would get the step up on the date of death.
So something to consider, definitely in the estate planning piece
Yeah.
of how you own that property, the titling of it. This is another good question that just came in from Jamie. It says, if you are part of a limited partnership that is selling an asset and liquidating, can one of the partners or all the partners exchange their proceeds into a 1031? In other words, can they do it individually as they see fit, or do they have to do it together? How do you handle that?
Well, I'll jump on that and
Okay.
include everybody. I think Corey and I have seen this in previous transactions. If you have a hot tub time machine and you can go back in time, you would say to these folks, owning in an LLC or a partnership, an entity that's taxed as a partnership, can be problematic when the various partners want to separately do 1031 exchanges. And so reconfiguring the ownership well before the transfer, before the sale, might be advantageous. So oftentimes you'll see people converting to a tenancy in common or a partial tenancy in common, where you take those various individuals out of the partnership and deed them an undivided interest in the underlying real estate and have them hold that interest for some substantial period of time, so that they can say, I've held this property for investment or business, and I'm going to do a 1031 exchange on my slice of the relinquished property. Now, I think that requires coordination with everybody that's on this Zoom call. You need to have coordination with the accountant, the lawyer, and the financial planner, as well as the intermediary, because even if we break up as tenants in common, but we still continue to report the asset as a partnership asset, we may not have advanced the ball because we've continued to conduct ourselves as a joint venture or partnership. So planning ahead is always a good idea, and involving your accountant and your lawyer and the intermediary early in the process can only benefit you. And this is a controversial topic because some lawyers will say, look, I can win that case all day long. Let's drop and swap the day before the sale of the relinquished property, reconfigure the ownership right before the transfer. Other lawyers are like, I'm not comfortable doing that. I think we should break up a year or two in advance and hold that interest separately as a tenant in common for a substantial period of time. And there's a great degree of difference of opinion on this. And the IRS has been a little bit inconsistent between what they say publicly and what they do in court. We haven't seen a lot of enforcement on drop and swaps for like 2 decades. So there's a little bit of controversy in this area.
Is there a way for somebody right now to, let's just take somebody that has something above the estate tax exemption, so above the 11,700,000 the way it is today. Can they gift shares or operating units, let's just say of a family, of a REIT that they have, or of their assets that they own, into a family limited partnership, but maintain control still of the family limited partnership, but they've essentially gifted those operating units out of their estate, and then also continue to get the income for themselves off of these investment properties, whether let's say they have 3 kids that are in this partnership. So they're the general partner, the children would be limited partners. Do you see people do anything like that, or ways that they're getting this property out of their estate, so to speak, but still maintaining control and getting the income from the property? Brian or Corey?
Yeah, there are quite a few techniques that involve lifetime gifting in order to manage your taxable estate at the time of your death. Obviously, assets that are appreciating rapidly in value are the type of assets that you would like to transfer to your children now. If, you know, in the interim 20 years, they're going to double, triple, et cetera, in value. Getting them out at a current value as opposed to that future value will be a tax savings. There are also other estate planning techniques that allow the transferor to retain a stream of income, either sales to an intentionally defective grantor trust or a GRAT, which is beyond the scope of this seminar. But I do want to point out, as Corey had said before, that those types of transfers will be a trade-off with the stepped up basis that would occur. In order to get that stepped up basis advantage, you need to have it includable in your taxable estate. So as you make those decisions about lifetime transfers versus dying and owning the asset, you need to be conscious of those two trade-offs that are occurring.
So let's say somebody was very proactive today in their estate planning, and Corey and Brian, they worked with both of you to get everything set up because they have a strong belief that the stepped up basis is going away. This is their opinion. And they do all the planning, they get all this done, and they give property away. They get below the exemption of the state tax exemption today. And then 5 years from now, they realize that the stepped up basis didn't go away, or that it did go away, and then at that point in time, it was already restated back in. Can they unwind that, or is that very difficult to unwind a strategy like that?
Sometimes we talk about sticky finger gifts, but as Corey had said earlier, those transactions, in order to eliminate it from your estate, need to be irrevocable with an I as opposed to revocable with an R. And so you need to give away the asset, and unwinding it is a challenge. That's why pre-planning is very important, and having some confidence as to what you're doing, given the level of uncertainty around the tax code, is something that is a challenge for all of us on the phone or on the webinar today.
There are also some rules to prohibit the deathbed gifting game of transferring a bunch of appreciated assets to someone that's about to die so that they can pass it back to the heirs with a step up. So you got to be careful about that as well.
Well, there's a lot of great questions coming in here, so we're going to stay kind of on this line of the topic here. One of the questions is, vacation property. So can you take an investment property here? You want to get out of Minnesota. This goes back to, like, I think what all three of you had mentioned earlier, people in the state, and they move to Florida. Can they buy an investment property down there, let's say a vacation home that they rent out for a few years, and then convert it to their primary residence in Florida 2 or 3 years from now? I mean, do people do that?
Yeah, I think that's a pretty good strategy, actually. I mean, you might have somebody who's actively involved in real estate up north, and then they decide to retire in Florida. You know, it's a good plan. You get out of the rental racket, and you move in. Well, I guess you'll be in the rental racket for a couple of years in Florida, because you want to maintain that investment business use, and then after you've got a couple of years, and it's kind of a consistent message that all of us have said, keep using it as a business asset, and then after which you can convert that to personal use. You want to make it old and cold, basically.
But, you know, there's some interesting developments in that area, because in the Florida Keys and in other areas, either by association rule or by municipal rule, there are limits on residential rentals. And so if you're going to buy a condo or a townhome in an area, you need to do your research and make sure that you can actually rent out the unit. And not only do you need to read the original association rules, but you also have to read any recent amendments. We just had a client that was under contract to buy a replacement property, thinking that they could rent it without any restriction, only to find out that the association had passed a rule constraining that, so that no one could rent the property during the first year that they owned the property, which is going to make it hard for them to substantiate that they're holding it for investment or business when they're prohibited from renting it. Florida Keys, I think the whole area there is now limited or has put severe restrictions on future rentals, but have, using the grandfathered term, grandfathered in the previous people that were doing it. And then in northern Minnesota, there are areas where Airbnbs and intermittent rentals have been severely curtailed. But that is a great strategy. The buy it, rent it for a substantial period of time, and then perhaps if you have a change of circumstances, move into the property later and make it your primary residence or second home.
Thanks, Jeff. Great info. We have a question coming in from one of our previous panelists, Dustin Cans, out of our webinar that was called Booming Rochester. And he's asking, can I take my investment property and transfer it into a farm operation where I live there and actually operate it?
You know, my preference is to break that purchase agreement into two pieces and buy the farmland, the tillable acreage that is going to be used for investment or business purposes with the 1031 funds, and to buy the little postage stamp farmstead with separate non-1031 funds. Now, I suppose there's an argument that those cows are not going to milk themselves and that the farmer has to be on site for the convenience of the employer, the farm operation. But I think the optics look best if you buy the domicile home with separate non-1031 funds and exclusively use the 1031 funds for the land and the farm buildings that are used for business. That's my preference. Now, the problem is it's hard to subdivide and break off that little chunk that's going to be used for the homestead. It's administratively challenging to do it because there's some regulations about how big the parcel has to be before it can be broken off as a separate tax parcel identification number. And you may have to pay to get a survey for that little farmstead portion.
I'd also point out that we had some experience bumping into the prohibition on corporate-owned farming, and so the ability to do that transaction may very well depend on the type of entity that owns the disposed of or relinquished property, because it needs to be the same taxpayer on both ends of the transaction. And if you violate the prohibition on corporate-owned farming, you might not be able to complete that transaction for another reason.
Very good, excellent, thank you. And thanks for the questions, everyone. Remember, you can hit the chat button for any questions that you might have. This is a follow-on, Corey. I think I'm going to direct this one to you at first, because when we had talked in the past, you had mentioned you have some limited experience possibly with California and clawbacks.
Yeah.
With all this talk of people moving south, is part of their estate plan, could it be something that could catch you, that you have to be careful of if you do move from one of the several or very few, I guess, states that may have a clawback provision if you do that?
Yeah, and after we talked about that, I looked, there are a couple of states out there that have that clawback rule, but we had a situation, in fact, I worked with Jeff on this one. We had an individual out of Minneapolis that had some real estate that they sold, had a very large gain deferral. They did the 1031 into California property, and the California property didn't work out. It turned out to be kind of a money pit. And after a couple of years of sinking money into it, my client said, yeah, I'm getting out of here. What am I going to owe? I'm done with real estate on this. I'm cashing out. So we went through the calculation. Turns out California has a clawback, meaning that if you leave the state of California with the 1031 deferred gain, California is going to follow you every single year thereafter. And you have to file a statement with them every year, declaring, that you haven't sold the property and identifying your deferred gain. Well, at the same time, they also wouldn't make my client recognize his gain from the Minnesota deferral. So basically, he had a loss on his California property and a gain related to the prior Minnesota deferral. We didn't have to pay any capital gains at all in California. So our gain was, at the state level, was locked to Minnesota for that purpose, and zero in California. So the clawback is in their favor if you have a 1031 gain leaving California, but not going into California. So
California,
does that make sense?
yeah, California is not a real friendly state from a tax perspective, and the fact that they track you down years later to put their hand out if you ever sell your replacement property that's acquired in a different jurisdiction is just one of the, many nuisances that you have to deal when you've owned real estate in California. And it's an important thing to know that if you ever sell your replacement property in a taxable transaction, you're going to have to perhaps pay the piper at that time, which is maybe another reason to continue to defer, die, because you want to, hold back the federal tax, but also the previous state taxes that may follow you out of states like California. Now, Minnesota, to my knowledge, doesn't track you down or even follow you to another state. Once you've left Minnesota, you've left Minnesota.
Yeah, that's true. That is true on a 1031, but they actually, if you had an installment sale out of Minnesota, and we're not on that subject here, but just as a matter of point, Minnesota would track you for the installment sale. So if you moved down to Florida, Arizona, Texas, you'd still be paying that installment gain to Minnesota.
And I just reiterate that changing your personal residency from Minnesota to Florida, which has no estate tax, won't avoid the potential Minnesota estate tax on your Minnesota real estate holdings, because those are, especially, or if they're held in a pass-through entity or in your individual names, Minnesota treats them as taxable here as long as the real estate is located here.
Well, Brian, if I had amassed a lot of wealth in Minnesota and I've already moved down to Sarasota, Florida, and I've decided, I can't manage my real estate from so far away, I think I'm going to sell my Minnesota real estate holdings and redeploy them into Florida assets so I can keep an eye on them better. Would that also potentially benefit me from a Minnesota estate or inheritance tax perspective?
It would, because as I said, the look-through is only as to real estate located in the state. And as Corey points out, for estate tax purposes, there's no tracing of those assets once the Minnesota real estate is disposed of.
Very good. Interesting.
I want to just talk about something that we started with a long time ago, and that is you've got a husband and wife that have scrimped and scraped and clawed and managed their affairs very well, and they've been successful either in farming or in apartment building management or other real estate, and they've worked very hard to accumulate a lot of equity in real estate, and they've been very prudent about it. Now they're looking at the next generation, and the kids either don't have the bandwidth to do it because they have very busy careers, or they don't have the desire or aptitude to take over their real estate holdings. And they may be that the children have very different lives. They may be different parts of the country. So how could the new products that are out there that are sold by firms like Morgan Stanley and Ameriprise and others, can these new products called DSTs be used to make it easy for the next generation to take over the wealth? And Tom, maybe you want to help us with that one.
Well, I think there the biggest thing that you come across is liquidity and the ability to still be in real estate, but not have the burden of managing it. Very similar to what Corey said, you can be out of the rental business. And you can carry that with you wherever you go. So if you did move to Florida, and I presume you guys could give advice on this, but if you still maintain your real estate, you're in the asset class of real estate, you get a dividend, it's a stepped up basis as long as it's there. You move to a different state that doesn't have a state income tax, and then you start to liquidate at that point in time if that's what you chose to do. You could possibly be not paying any state income tax on that gain if you're in a state that has no state income tax. Is that correct? Corey, you want to take that
Oh,
one?
yeah, I'm trying to hit
We saw you were
yes,
trying to hit
correct.
the mute button, right?
Yeah. No, that's absolutely correct. You know, if you are exchanging into a DST and all of a sudden you find yourself in a zero tax state, in a zero tax estate tax state, you would avoid the state tax altogether.
Some of these DSTs stay as a portfolio of real estate for their entire life. And then when the DST has run its course, the sponsor sells the DST, and everybody that's invested in it has an opportunity to do another 1031 exchange or to take their cash. Maybe we'll call that the traditional DST. And then another category of DST seems to be set up so that it's initially, and it's an investment in one or two pieces of high grade commercial property. And then after a period of time, those pieces of property are put into a REIT, a real estate investment trust. So your investment sort of morphs from a DST to an UPREIT position. And I think that kind of DST is intriguing from an estate planning perspective, because if I've got 3 children that are in maybe different places of the country, they maybe get along or don't get along, and I need to have a divisible asset that I can slice and dice and give 20 shares of the REIT to Susie and 30 shares of the REIT to Bobby and so forth. I've got a nice asset that I can slice up, because if I were to give them an apartment building that they would mutually own, that would be a train wreck, because they'd have to agree on how to run the apartment building together. And maybe they're situated all over the country and have no desire to run an apartment building. And it's hard to slice and dice a single asset like an apartment, but a REIT can be divided up. Those shares can be divided up after my death. And I think they're much more liquid than traditional brick or mortar real estate. Any thoughts on how to use these new product types to sort of affect the intention of the maker of the estate plan?
I think the point about divisibility is a very good one. If the stepped up basis continues to be applicable and the individual that has rolled into one of these new opportunities dies owning those assets, you will receive that stepped up basis. So liquidating at that point in time when the interest in the UPREIT is transferred or the DST is transferred will be an opportunity for the inheritor to avoid both the income tax and become liquid. So there are some advantages to that if it fits nicely into the family planning dynamic.
Or they can just keep their shares in the REIT because they've got a stepped up basis and they get to redepreciate the underlying components.
Correct. That could be, as you said, Bobby's choice, and Susie could go a different way, which is what provides some of that additional flexibility we talked about.
Powerful tool.
Well, we're seeing a lot of people looking at these alternative real estate investments because they're able to sell their farms and their apartment buildings right now at a very high premium, but there's very little replacement options out there. And being able to go into a management-free passive investment in your golden years is very attractive. If all you have to do is go to the mailbox and get your distribution check once a month, that looks very attractive to someone that has toiled really hard throughout their lifetime to manage and accumulate this wealth in real estate. And the DSTs seem to be right now very popular. I'd say a good 25% of our clients are using or considering using DSTs as their replacement solution. And I think that trend is likely to continue. As interest rates are low right now, velocity in the marketplace is high, and inventories are tight, I think we're going to see even greater use of the DSTs as a replacement solution in the future.
So we've got about 12 minutes left, so there's a couple of really good questions I'd like to get to. One of them kind of goes back to following up on what we talked about, using your proceeds to buy a vacation property, so to speak. This is a little different. It says, can I transfer my investment property, do a 1031 into a house here in Minnesota and then rent it? How long do we have to rent it before I would move into it myself? So is there any kind of guideline of how long somebody should have it as an investment property before they try to take it over as a primary residence?
We have 4 professionals on this Zoom call, and I think all 4 of us could give a right answer that's different. I think the safe answer is the longer you hold it, the better. I had one client that bought a home, rented it through an executive relocation firm to a Medtronic executive that was coming into the Twin Cities and needed a place for 18 months. She rented it for 18 months, market rate rental. She had a signed lease. She had a signed relocation agreement. She had 18 rent checks, and still she got audited when she'd converted that property to her personal use. And she won the audit, but she had to substantiate that she really did intend to use that property initially for investment or business purposes. And it was emotionally taxing, if not financially taxing, to go through that audit process. I think, consider yourself on 1031 probation after you acquire your replacement property, and make sure that you're using it for investment or business purposes. Maybe you do 2 full 12-month periods of solid investment business use to really substantiate that that was your intention. But nobody really knows the answer, because the IRS has to some degree hidden the ball and has not issued a bright line objective time frame that you must hold the property. They say you must hold it for investment, but they don't define how long to hold it. So it's a problematic situation.
That's a very accurate and complete answer. There is no number in the code that is on the safe side. There are some references to 2 years in certain statutory areas that we professionals have looked at as being supportive of that type of a deferral, but there's nothing concrete that you can rely on. I just wanted to throw one other sidebar in because it's an experience that I've been going through quite often recently. Because interest rates are so low, a lot of real estate owners are taking advantage of refinancing their existing mortgages and locking into those long-term rates for 10, 15, 20-year periods of time, which is a wonderful opportunity to improve your cash flow, but you need to be conscious of the prepayment penalties that might be incurred in the event that you wanted to liquidate that asset after a death and take advantage of the stepped up basis. You might be caught by surprise as to the penalties that the lenders are charging in terms of yield maintenance when you prepay those assets prior to their maturity. So just an additional item to put in your checklist as you deal with your real estate and your estate planning. If the goal is to liquidate, as Jeff had suggested, because there's no successors who are going to take over that property, you want to keep in mind that prepayment obligation that might occur when your next generation owners want to sell that asset.
Very good point. I know this one's going to generate some activity. This will be similar to the last question, where everybody's going to have a different opinion out of the 3 expert panelists. So what happens if somebody waits to the bitter end, or unfortunately has a negative event where they become ill and they're doing a 1031? They might be in the 1031 process, or maybe it's inside of the DST at this point and not uprooted yet. What are the implications of a death either during a 1031 process or during the DST phase of going into an uprate?
I think generically, if you think about this from the heir's perspective, they probably want to receive property as an inheritance. And if you think about it from the decedent's perspective, they're still going to have to file a tax return for the last year of their life. And that tax return is either going to show a taxable sale because they failed to complete the exchange, or tax deferral because the estate, in this hypothetical, the personal representative of the estate will acquire the replacement property and then later distributed it out as property to the inheriting heirs. I think most of the time when we've seen this, a death in mid-exchange, the estate completes the acquisition of the identified properties, and then tidies up the distribution of that property to the heirs later as part of the winding up of the estate of the decedent. But most often, people complete the exchange and then report the 1031 on the last return of the decedent's final tax return.
So would they still get a stepped up basis then, if they're midstream?
I think they get their cake and they eat it too. The decedent gets the tax deferral on their last tax return, and then later the heirs receive the property as an inheritance with a stepped up basis. I think it's probably the best outcome is to complete the exchange.
Is that true with an opportunity zone as well? If somebody did a 1031 years ago, the 1031 is done, they 1031 into an opportunity zone, say when the opportunity zones first became available, and then they passed away. Is that the same treatment as if you went into another property or to a DST or to an got uprooted?
You know, I think that most QOZs are funds, they're partnerships. But you could actually buy real estate that just happens to be in a geographically designated QOZ zone. But I don't know if it's going to change the analysis if it was a 1031 into the property. It's probably not being done as a QOZ. It's being done as a deferral. And I'll just, pontificate for a second here. I don't really love QOZs. I don't like qualified opportunity zones. I like 1031s because the deferral is indefinite, maybe perpetual, whereas the qualified opportunity zone deferral is only until December 31st, 2026. And at that point, you're going to have to pay the piper. I think there's going to be a lot of unhappy people at the end of 2026 that now have a tax bill that they have to pay. Now, some of that deferred gain may be forgiven, but I hope that there's a lot of liquid people ready to pay their taxes at the end of 2026, because that deferral is perishable under the qualified opportunity zone strategy, whereas 1031, it's defer, 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 die, and it's sort of indefinite. I prefer 1031 for real estate investors, and for other people that have partnership interest or selling stock or other property that doesn't qualify for 1031, the QOZ is a fine strategy, but you need to know the rules of the road. And I really think there's a lot of people that are getting into them that have misconceptions about what the tax deferral is and what the advantages are.
Very good.
Yeah, I'll just piggyback on that real quick. With the QOZ, I mean, we're really talking about the gain deferral. And the gain deferral is exclusive of a 1031. So if you're doing a 1031 into that property, I think you got your 1031 property, you never recognized a gain. And then if you have another person who sold the property, they have a gain, they take those proceeds and put it into QOZ. Now you're really dealing with the QOZ rules with that gain deferral, not with something that's like out-of-pocket money or not money designated as QOZ funds. So.
Great information. I think that Patrick will be happy with, or Justin will be happy with that answer. We have just 2 minutes here, so I was going to ask a question here. I think this might go to you, Corey, but all panelists, please, jump in on it. Can you be reimbursed for expenses from the QI? So let's just say during the 1031, you had out-of-pocket expenses to do whatever it might be, inspections, appraisals, surveys, whatever. And you paid that out of your own pocket. Can you, Corey, get reimbursed for that money from the QI or from the proceeds that are with the QI?
Yeah, so I'll just give you a real quick run through on this. So the gain that a person recognizes on a 1031 would be the equal to the gain deferral or the boot recognized, the net boot received, I should say, lesser of the two. So if an individual is putting money into their exchange and taking money out of that exchange, you can net those funds. So if you put 10,000 in and took 9,000 out, you would have 1,000 paid. So, but if it was the opposite, 10,000 of receipts and 9,000 going in, you would have boot received of 1,000.
Corey,
Yep.
here's what a lot of people do. They have a duplex and they clean out the duplex, the tenants move out, and they spend $12,000, touching up the duplex and getting it ready for sale. They do repairs, they put new linoleum in, they do paint, they do all of those beautification things to get it ready. And then when the duplex sells, they want to reimburse themselves for the $12,000 that they had put in repairs to get it ready for marketing. And I think that's where people get a little bit maybe greedy. The better play is to only pay transactional costs that are customarily seen in that locality. So if you have an attorney's bill, an accountant's bill, a real estate agent's bill, recording fees, state deed tax, those kind of expenses, that would be permissible to pay out of proceeds. But I'm not sure that you get to take a reimbursement for beautification costs that were incurred to repair it.
Okay, I didn't, if that's what you said, Tom, I missed that.
No, well, that's an add-on, but that's really good to get that in there because that covers it all.
Yeah, I was actually talking about transaction costs within the 1031 because there are appraisal fees that happen up front and some other things. So,
and I'm just going to say, is it a good idea to involve your attorney and accountant at the end of this transaction when it's already done, or do you want to involve your attorney and accountant throughout the whole process? There's a lot of landmines in this area. You need to buy replacement property of equivalent or greater value in order to defer your gains entirely. And, yesterday I was on a call with someone that bought replacement property, but it was about $2 million less valuable than the property that they had sold. And they don't have a lot of time left, perhaps, to complete their purchases of the identified properties. So if they had been tighter, closer consultation with their accountant and lawyer, they would have maybe been more aggressive in getting enough value to complete their exchange. And there's a lot of transactional costs that can be problematic, that are more operational than transactional, like property taxes, rent prorations, security deposits. And many people are cash poor, real estate rich. They don't have a lot of liquidity to pay the operational related expenses out of pocket. But with some planning and consultation with your professional advisors, you can navigate these landmines better. So I really suggest the time to get the accountant involved is at the beginning. And it's kind of sad between, say, March 1 and May 15th, many accountants are super, super busy doing tax returns and just trying to deal with the flurry of activity that they have, and they don't have as much availability to consult with people that are doing transactional work. So you need to plan ahead for that too, the availability of your advisors as well.
Excellent point. Very good. Right on. Well, we're to the end of our webinar today. I want to thank everyone again for attending. It was terrific turnout. Thank you to Corey at BGM, Brian, Siegel, Brill, of course, Jeff at CPEC. Thank you for your time. And the event is recorded, and Alec has or will be sending out all the contact info to everybody on the call today. So thanks to everyone and have a good day. And we look to see you at the next one.
Thank you, Tom.
Thank you, everyone.
Thank you, Tom.
Yep, talk to you soon.